Hey, everybody, and welcome to another episode of SRT Live. I am your host, Sean, with the Sean Richard Mortgage team over here at Guaranteed Rate. Thank you so much for joining me today. And the Fed is waiting for a jolt to the labor market. When are we going to get it? We're going to be talking about that today. And so let's dive right in, as always, with our week in review. Last week was a big week. We had a lot of information come out for the economy and our housing market. Starting with new home sales. New home sales actually took a little bit of a dip, albeit a little bit surprising, being that that's going to be the primary source of a lot of our inventory moving forward. But new home sales dipped 3.5% to an annualized rate of 697,000 homes sold. Now, we also got pending home sales. Pending home sales came in up significantly from the expected rate of down of negative 0.5%, came in all the way up 0.3%. Now that might seem a lot, but almost a full percent higher than expectations was a pretty big deal. And we also got the big news last week, which was the Fed meeting. Now the Fed met Tuesday and Wednesday, and they elected to increase by 0.25%. This was expected. This wasn't any headline news. The Fed funds rate, as a reminder, doesn't impact long-term lending rates like mortgages directly. It has an indirect impact because it does impact the economy, which ultimately does have an impact on mortgage rates. But the Fed funds rate is your overnight bank-to-bank lending rates, and it impacts a lot of your short-term products or unsecured lending. So the Fed increased the Fed funds rate by 0.25%. We're going to get into the comments from Fed Chair Jerome Powell here in just a bit, but we have seen 5.25 increase, or 525 basis points increase in the Fed funds rate since they began increasing the Fed funds rate within the last couple of years. So hopefully this is the last increase that we see. We also saw the ECB, or the European Central Bank, mirror our Fed's increase with 0.25% of their own, also to combat inflation. And then we also got GDP for Q2. Now, every quarter, we get a total of 3 GDP readings. So after the quarter ends, we get the first reading. In August, or this month, we'll get the second reading for Q2 GDP, and then in September, we'll get the third reading. GDP came in a lot stronger on this initial reading than estimated. Experts were expecting 1.8% growth in GDP, and it came in at 2.4%. It's a pretty big uptick. Some of that probably has to do with the strength in the labor market, and we're going to get into that as well, but ultimately came in higher than anticipated. On Friday of last week, we got PCE, which, if you've been watching me for a while, you'll know is a critical inflation report. PCE, or personal consumption expenditure, is the Fed's favorite measure of inflation. And that came in lower than expectations. Month over month, we saw it beat expectations by 0.3%. So it came in at 0.2. And then year over year, we actually came in at 3% versus 3.1% on the headline number. Headline meaning including food and energy. Now, the Fed likes to look at core inflation on the PCE report, and core inflation also came in a bit below expectations, came in at 4% year over year versus 4.1%. Anytime that we can beat expectations on inflation is a positive for the economy, and ultimately a positive for long-term mortgage rate declines. So really good information coming out of the PCE report last week. And then also last week, as always, we get our jobless claims, initial and continuing. Remember, initial claims are individuals filing first time. Continuing claims are those individuals that are renewing their unemployment benefits. And we've seen a lot of strength in the labor market, and this was no different in our jobless claims. Week over week numbers on initial claims came in at 221,000. This is versus 228,000 the previous reading. Now, we've gotten up into the 240, 250,000 week over week numbers, And we've seen a steady decline over the past several weeks. And then continuing claims, we saw a pretty significant decline as well. We saw that drop almost 60,000 to 1.69 million continuing claims. And I've talked about this at length, but this just goes to show the strength in the labor market. And that has been one of the hurdles that the Fed has had to overcome when it comes to inflation. Now, today, we got some more labor market information. We got the JOLTS report, which is the job openings report. This measures job openings across the country. Now, we were above 10 million for quite some time. We did finally dip below that, and we're seeing job openings steadily decline in recent months. And so the job openings were down 250,000, down to 9.58 million job openings. And again, doesn't seem like a massive decrease, but when this continues to go down, we were up at like 10.3, 10.4 million not too long ago. This speaks to a potential softening in the labor market, which is really important for inflation. With the labor market being extremely tight, it does point to wage pressured inflation. If the job market's tight and employers are having to fight for employees, that's driving the cost of labor up, and that's creating wage pressured inflation. So as job openings come down, that means less competition from employers on employees. It's going to help soften that job market. If you're out there looking for a job, it's not the ideal news, but this does go a long way towards helping our economy and ultimately helping the mortgage and real estate markets. All right, so let's take a look at what we've got ahead this week. And this is a pretty big week because it's jobs week, which means on Wednesday or tomorrow, we get the ADP private payroll report. And then on Thursday, we get the jobless claims as we always do. But the big data point, the big economic news this week is coming out on Friday. We're getting the BLS, or Board of Labor and Statistics, jobs report. And that means we're also getting the unemployment rate. So we're going to see how many jobs were created in the month of July. Again, this is just another component of understanding the labor market. Last month's jobs report, we got a gangbuster number, and it's just been a constant beratement of how strong the labor market is. So seeing a weaker jobs report would actually be a refresher for our real estate and mortgage industry because it's helping the economy combat inflation. All right, so what does it all mean? And today we're going to start with talking about the Fed, because the Fed has been raising the Fed funds rate significantly over the past 18 months. They obviously just raised it 0.25%, and that puts their total increases over the last 12 to 18 months at 5.25%. And it's a massive increase in all of the things that are dependent, all the lending and products that are dependent on short-term interest rates, like auto loans, like credit cards, like unsecured lines of credit. All of those are being impacted by the Fed increase in the Fed funds rate. And it's putting a lot of pressure on affordability for consumers. So we heard from Jerome Powell after the Fed meeting. Every time there's a Fed meeting, he does a press conference afterwards and has prepared remarks. And ultimately, some of the remarks led to the fact that the Fed is open to additional increases in the Fed funds rate, but they're going to be very data dependent. And Jerome Powell has used that phrase significantly over the past 6 months, is data dependency, data dependency. One of the hurdles, in my personal opinion, with data dependency is they're looking at reports in the past. They're not leveraging the ability to forecast into the future. And when we're looking at reports based on past information, it does lead to the Fed being more reactionary versus proactive. Now, that's the levers that they feel that they have the ability to pull. But if they do decide to pause on the rate hikes, we likely will see positive movement in both the stock market and the mortgage rate market. So that's something to look forward to. However, the Fed's next meeting isn't until September. So we're going to have a lot of data, economic data, come out between now and the Fed's next meeting that has the potential to influence their decision in their September meeting. So let's stay tuned and keep an eye on the inflation reports that we get over the course of August. And hopefully that'll give us some indication on what the Fed may do come their September meeting. All right, gang. Well, that's what I have for you today on this episode of SRT Live. I just want to say, if you're watching in our Powerhouse Facebook group, thank you for being an incredible part of our community. If you're checking us out on the YouTube channel, make sure you hit that subscribe button so that way you've got up-to-date real estate, mortgage, and economic information in the palm of your hands. Thank you so much for joining me on this episode of SRT Live. I'm your host, Sean, with the Sean Ritchie Mortgage Team. Have an incredible rest of your day.